Hello, it's Lon Welsh at Ironton Capital, and it's December of 2024, and I want to talk a little bit about what's going on in the multifamily industry. There's a lot of exciting news to report, so let's get started on it. The first is absorption has been really strong. And what I mean by that is there has been more new households taking a new apartment unit than there's been households giving up an apartment unit. So it's a metric of the demand of the market to take on new apartments. And you can see in this chart the net absorption over the last 24 years. And in 2024, that green line is just the first 3 quarters of this year, and it's already the second best year in the last 24 years. And I think when you see the fourth quarter data get added on here, you're going to see this is an all-time record. So far this year across the entire U.S., there's been a net of 490 new rental households that have taken what was before an empty apartment and filled it up. So if you take a look at this another way, the dark blue line, and this is from 2010 to current, so about 14 years of data, the dark blue line is the new supply being added into the market, and you can see this year was a very large year, and you can see that the demand is the gray line. So you can see that there was a lot of demand in 2021, right after the COVID large checks were passed out to everybody. And the light blue line is the difference in between those two. So you can see that there's a lot of new apartment supply being delivered right now, but that we're absorbing almost as fast as these new units are coming to market. So while the number of vacant units is slightly increasing, so the vacancy rate is slightly increasing right now, it's only by a little bit. If you would have looked at the headlines 2 years ago, you would have seen from the experts they saw a gigantic amount of new apartments coming online that were under construction with no indication there was going to be a huge amount of demand, and that there was a huge worry there was going to be all these vacant apartment buildings having to throw lots of money at concessions and that rents would have to go down, and that doomsday scenario has not materialized. So why is that? And the core that's driving all this absorption is that household formation has been incredibly strong. So if you take a look at new households getting created, and this is from 2002 to current, so this is about 22 years of data, you can see the dashed line shows the average is about 400 new households being created per year, and that recently we've been above the average. So an incredible amount of household formation. So examples of where household formation would occur is you have a child who's an adult living with their parents. Maybe they're finishing off their college degree. They wrap up their degree, they get a job, they move out and get their first apartment. That's one unit of absorption. Or you might have two roommates living together sharing an apartment, and they both get either promotion or they get a better job that pays more, and now they've got the financial means to have their very own place and not have to share an apartment anymore. That would be one additional unit of apartment absorption as we create a household. These tend to happen during times when the economy is very strong. Now, during a recession, you see the exact opposite occur. A young adult might lose their job, they can't afford their apartment anymore, and they've got to move in with their parents. So that's destruction of one rental unit, and then so there's an extra vacant unit out in the market that's got to get filled. So since the economy's been strong, we're creating lots and lots of households. And the big driver that enables this is everybody employed who wants to have a job, and are the wages going up fast enough that people can afford the rents as they go up over time? And the answer is yes. Unemployment is very low, employment is very, very strong, and wage growth has also been strong. So here's 3 different ways of measuring what's going on with employment growth rate. They all kind of get to the same conclusion that wage growth has been stronger than inflation. So the absorption has been very strong in the last couple of years while we've delivered a record number of new apartment units on the market. And since the demand has been strong, the discounting required to fill all these units, otherwise called concessions, has been a lot smaller than average. So you can take a look at the share of U.S. apartments having to offer a concession to fill the vacancies, and you can see like 2 cycles back, those 2002 to 2006, an average of 41% of apartments had to offer a concession. Between the 2008 to 2019 cycle, 28% had to offer a concession, and now it's only 15%. So there's a lot of variability on this by MSA, by submarket. For example, if you're in downtown Denver, there's a lot of new deliveries, and the demand hasn't been growing fast enough to keep pace in that itty-bitty submarket. So in downtown Denver, there's a lot of concessions. But if you're in suburban Denver, there's almost no concessions whatsoever, because in the suburbs of Denver, for example, supply and demand are very much in balance. So this has been very good overall for the entire apartment industry. So what's going to happen next? Well, what's great about new deliveries of apartment buildings is that they don't just happen overnight. It's usually about a 24-month lead time from the time that you pull a permit and break ground, building the building, getting the certificate of occupancy, and actually getting it out there on the market is about 24 months. Leading up to that, you see an uptick in architectural billings and other pre-construction activities before construction even starts. And what we can see right now is that if you take a look at the extreme right-hand side of this chart, there's about 190,000 more units being built this year than there's new, and that's being built and delivered, completed, than there are units being started. So while we're on a rampage of new unit deliveries right now, there's almost nothing in the pipeline behind it. So I don't think the starts are going to rebound anytime soon, and some of this information comes from Hill Point, so I'm in debt to them for having done some of this primary research. So the multifamily starts right now are off by 50% from the cycle high about 2.5 years ago. And at the moment, there's no rebound in the number of starts that we can see. So all the leading indicators we would normally look at are looking very, very low. So permits, surveys of developers saying, what have you got coming up sometime soon? Talking to banks, talking to architectural firms. There's not a lot of new apartment starts in the pipeline right now. So there's a lot of developers that have got a project that's permitted, and they have decided we're not going to start this until we see the market's a little bit more robust in our submarket and our specific MSA. And I can tell you that at Ironton, in some of our earlier funds, specifically Fund National Diversified Fund 3 and Fund 4, there are portfolios that we invested in where some of the projects are started and some of the projects are on pause. They're going to just wait a little bit, which will delay how fast that fund will wrap up, but it'll also mean a much more robust exit and much higher returns for the investors once those exits are achieved. So this shows you the deliveries. So you can see that 2024 is the peak year for the entire United States. An absolutely mind-boggling 600,000 new units are going to be delivered this year, and probably almost all of those will be absorbed as they come online. Next year, pretty strong year of about 500,000, but certainly down some, and then looking at the 4 years after that, next to nothing. So for 2026, you'd have to be breaking ground today. So this is like, November 27th as I record this. If you haven't broken ground today, there's no chance of you delivering a 26. Like, you're going to be delivering a 27 at the earliest. So we can be pretty confident that we've got a couple years of very low deliveries coming up. So the peak delivery month will vary depending on the metropolitan area. So looking at Denver, for example, the first half of 25, we've got 18 new projects. There's 18 MSAs where the peak is in the first half of 25. Denver is among those. There's about 9 of them that are peaking right now. So what's going to happen going forward? Well, I am of the view that first-time buyers are going to be locked out. You know that across the entire U.S., home prices are at a record high. We don't see any indications that prices are going to go down. I think they're going to be flat to increasing a very slight amount in 2025 and probably 2026. And that's largely a function of the fact that interest rates are pretty high, and I don't see that interest rates are going to drop for mortgages a whole lot. So right now, it's more affordable to rent than it is to buy in most of the larger cities across America. And looking at it from a different standpoint, if you took a look at a typical price house for an entry-level buyer, the typical mortgage, and you calculate the typical payment and say, what income would I have to qualify for that mortgage payment The answer is a little over $120,000, and that's the orange line on this chart. The blue line on the chart shows you the actual median income of the entire U.S. And you can see these two lines for a very long period of time moved in lockstep, but over the last 4 or 5 years, there's gotten to be a huge gulf where home prices went up a lot, wages went up a little, and it's very difficult for people to afford to buy. I think this is going to result in a lot of people who would ordinarily have been first-time buyers being locked out of the market. And in fact, I don't have a chart in here, but I have seen this recently. The National Association of Realtors is a study of who are the buyers across the whole U.S. And the first-time buyer share of purchases is at about a 20-year low right now. That's not going to reverse anytime soon. That means these renters will be trapped in their apartments for longer than they would have historically have expected. So this means you're going to see the vacancy rate start to go down in late 25, and as the vacancy rate goes down, you're going to see strong rent growth. And as rents go up, while expenses are relatively static, almost all of that incremental cash flow drops to the bottom line. So net operating income, the rents minus OPEX is the net operating income. NOI is going to grow at a pretty healthy rate for most apartment complexes in the back half of 25 and all of 26, 27, 28, and probably even 2029. This, combined with slightly more attractive financing terms for commercial real estate, will enable buyers to pay a little bit more as a multiple of cash flow, which means pricing for apartments is going to be higher. You may not know this, but there is a $250 billion, $250 billion has been raised and is sitting in different private equity funds and real estate investment trusts that are earmarked to purchase multifamily. And these buyers have been on the sidelines for a couple of years. And sooner or later, they're going to have to re-enter the market and decide that we're going to buy. And I think that's probably going to happen in late 25. There's going to be plenty of inventory for them to purchase. My first 8 funds at the National Diversified Fund, for example. So there is early evidence of a thaw in buyer activity for these large institutional grade apartment assets. So John Gray runs Blackstone, and his comment was, I think this time is a period of seed planting. You want to be invested in this dislocation. And what he means about that is that there's uncertainty in the market, so not a lot of buyers are purchasing large apartment buildings right now, so they can get slightly better prices right now. When the uncertainty passes, those investments are going to give accelerated returns, which is basically what I just talked about. And Blackstone is confident about the thesis that we just went through, and they're already starting to buy. So JLL, Jones Lang LaSalle, is a very large commercial brokerage, and they track institutional buyers who are out there looking for large apartment complexes, and they're all reporting that institutional buyers are up quite a lot this year versus last year. And I think the storyline is there's not a lot of new supply coming. There's lots of demand. Houses are expensive. First-time buyers aren't going to be able to buy. Demand is going to continue to remain strong. That means rents are going to grow. Cash flow is going to grow. We need to buy. We'll probably really see this uptick starting in late of 25. Thanks for listening. Let me know if you have any questions.